Imagine finally kicking off your journey to financial freedom with property development, only to lose it all because of one overlooked issue. If you're a property investor feeling stuck with low rental returns and dreaming of higher yields, but worry about losing all your hard-earned money on your first project, don't worry. Property development is not as risky as many people think, providing you take the essential steps to overcome key risks, which we'll break down in this video, covering the 7 biggest risks which you need to eliminate or mitigate to avoid a financial disaster or worse, bankruptcy. But before we even begin any project, we need to tick off the first biggest risk. One of the biggest questions you might have is, will I make any money? This is known as the profit risk. Imagine buying a property, putting in all the work to create new dwellings, and then not seeing $1 of profit, or worse, losing all your money. It's a scary thought, right? Here's the key: due diligence. Think of it like preparing for a big exam. You wouldn't walk in unprepared, so don't go into property development without doing your homework. But there's another risk that may impact whether or not your project will even go ahead. Let's jump into that. You might worry about whether you'll get the necessary permits to even start your project. This can feel like navigating a maze without a map. Planning risk is all about permits and approvals. The solution? Work with a designer who understands the local planning scheme or a good town planner from the beginning. They know the ins and outs of the planning process, which areas are low risk, and how to handle zoning and location issues. It's like having a GPS guiding you through the maze, ensuring you don't get lost. There's a myth that if you build it, they will come. That's not true, and another big risk, which we'll cover next. Imagine building a beautiful sandcastle, only for the tide to wash it away. Market risk is the fear that the property market might crash just when you're ready to sell. To mitigate this, perform a sensitivity analysis. Look at what happens if the market drops by 5 to 10%. Is the potential loss something you can handle? Understanding this helps you decide if the risk is worth taking. Remember, it's about being prepared for the tides, not getting washed away by them. However, even if the market is fine, that won't guarantee buyers will be lined up around the block to buy above your asking price. Imagine putting your property on the market and hearing crickets. No interest, no offers, nothing. Frustrating, right? Sales risk is all about finding buyers who will pay your target price. The trick here is understanding sales data and talking to a lot of local agents. Know your market. Are there buyers for the type of product and price you're aiming for? If you're aiming for a mid-range product, make sure it aligns with your profit targets. Sometimes, going for a higher end product can attract more buyers willing to pay a premium. It's about finding the right balance. Don't get caught thinking you can achieve a top price with an average product. That will get you into big trouble. All the risks we've discussed so far are usually done before the project begins, which leads us to a new list of risks for us to cover. Construction risk is like building a house of cards. One wrong move and everything collapses. Construction risk involves everything that can go wrong during the building phase. Think about budget blowouts or your builder going bust. To avoid this, do thorough research on your potential builder. Check their track record, talk to past clients, and see if they've had any issues with regulators. Choose a builder with a solid history, ideally one who's been in business for 10 to 15 years. Also include a contingency allowance in your budget, typically 5%, to cover any unexpected costs. Completing your project is exciting, but there's still one more risk that can eat away at your profits. Imagine planning a big celebration only for everyone to cancel at the last minute. Settlement risk is about whether your buyers will actually close the deal. You've sold off the plan, but will they settle? Target the right kind of buyers from the start: owner-occupiers and serious investors. Get solid deposits of 10%, so if someone walks away, you have the funds to remarket the property again. Work with selling agents who can qualify buyers to ensure they are reliable and will settle on time. Of all the risks we've covered so far, the next one is the most important and first risk that must be eliminated or mitigated by any developer. Finance risk is like starting a race with no guarantee that you can make it to the finish line. It's about whether you can fund your project to completion. Speak with finance brokers before you start. Understand common finance terms and conditions so you know what you need to do to satisfy lenders. Do a detailed feasibility study to calculate how much cash you'll need at each project stage. Being prepared financially is key to avoiding this risk. This is just the tip of the iceberg for each of these 7 risks. And if you want detailed guides and frameworks for how you can eliminate or mitigate each of these risks before you even start a project, then grab a free copy of my book, Become a $1 Million Property Developer, which is a must-read for anybody aspiring to become a successful property developer. The link is in the description.